a big miss on non-farm payrolls dampens the case for tapering. Yields back up ahead of Treasury bond issuance this week, and energy commodities like nat gas and uranium explode higher. All this and more in this week's Macro Insight. All right, so welcome back to Macro Insight, everyone. Today is the 7th of September, and let's take a look at these markets. So what happened last week? So going into Labor Day, we obviously had non-farm payrolls on Friday. That was the main data point, and it missed expectations quite significantly. Came in at around 250 when the expectation was 750. And then, you know, the market, some quite interesting moves really in the market, right? So weaker data, as we know, isn't something that the equity market seems to mind too much. But the move in Treasury yields was a bit interesting. So whereas normally on weaker data, you would see Treasuries rally, we actually saw Treasuries come off a bit. And, you know, people now, it's not like a massive move, but it is a move that is now sort of pushing up against the downtrend in 10-year, right? So let me share the chart here. So you can see here, 10-year yield has been in this sort of downtrend for quite some time. If we go back to like May, it's been respecting that downtrend resistance, and now it's just sort of pushing up against it here at around the 137 level on 10-year. Okay. Now, in terms of reasons why yields may be sold off, I mean, I would put it down to probably some cleaner positioning in the Treasury market after Jackson Hole came in dovish. And then you've also had, you know, signs of wage inflation, right? Average hourly earnings was a little bit higher. And then finally, you've got a bunch of issuance this week, right? So you've got 10-year and 30-year bond auctions in the US. And often you do see yields back up a little bit into those auctions, right? So you've got those factors that are happening there. Now, in terms of whether the yield move is going to really turn into anything meaningful and actually break higher, like it's kind of threatening to on this chart, I would say that unlikely, right? And the reason being that you've got various US unemployment assistance programs that are ending, okay? And that is likely a disinflationary force for the US economy into the year end, right? That assistance sort of ending, it reduces consumer demand and potentially also increases labor supply. So should bring down wage inflation if more people are out there who kind of forced back into the labor force because they're not getting free money from the government. And also, you know, if you're not getting free money from government, you might spend less, right? So those things are all going to have a bit of a drag on both inflation and on growth, okay? There is evidence from the states that have already ended the additional unemployment benefits. There is evidence of that demand effect and that reduction in demand, basically. And we're seeing that in retail sales disappointing for the last few months and things like that. Okay, so hard to see yields really trading significantly higher with that kind of backdrop. Okay, you also had Goldman's come out and revise their growth, as well as Morgan Stanley revised down their growth forecast for Q3 and Q4. Let me share that one there. Yeah. So on this chart, you can see Goldies bringing down their forecast. GS forecasts are the dark blue, significantly slashed it down to 3.5% for Q3, with a consensus more like 6.5, 7, right? So really aggressively slashing those forecasts, yeah? And you can see in general, you know, they're coming in lower for Q4 as well. They're looking a little bit more optimistic than consensus for early next year. But then, you know, we'll see. They're quite quick to revise that. They've been revising it pretty frequently, right? So I'm not sure how much you can read into those longer term forecasts, but certainly their shorter term forecasts are getting slashed. Yeah. So that's kind of what the outlook, what it's looking like for the economy. In terms of equities and how equities reacted, obviously, S&P kind of continued to grind out, you know, a new high, but really, really losing momentum, right? So if we bring up the S&P chart, if I bring up a 4-hour chart here, you can see that whilst, you know, we were from a week ago, you know, we bounced up at that 45.5 area, and we've been ranging in a pretty tight range, less than 1%. But each time we're attacking the high of the range, we're attacking it with lower and lower momentum, right? So we're seeing a clear momentum divergence appearing on the S&P as it loses that momentum, even though it's managing to eke out some higher levels, basically. Usually a bit of a sign that a pause is coming, at least, if not a correction, okay? So that's kind of what the S&P is shaping up to look like. In terms of gamma positioning on the S&P and how that's looking, if I bring up the, from our friends at Spot Gamma, we've got this chart here, right? So S&P, you know, we're at, where are we? Around 45.40 here, which is pretty much where we're at max gamma position. It drops off a bit as we go to about percent lower at 44.90. Then there's a little peak again at 44.40, and then a massive drop off below that, basically, right? So I would say that, you know, they're saying the gamma flip line is about 4,500, but really that peak on 44.40, I don't think that that is necessarily going to be a load of dealers being long puts necessarily. It may well be calls that have become in the money that are still there, that that clients are short and dealers are long. So you're probably going to have a bit of stickiness in the market as we trade in that range. Only if we break below 44.40 would I expect to see a little bit more turbulence and a bit more volatility to the downside, basically, right? So I don't think we're quite there yet. I think we'd need to see us a good couple of percent lower before we get into that area, okay? You know, NASDAQ showing similar signs, right? We have been eking out new highs, but as we are sort of reaching a bit of a flat line in terms of price, we're seeing that downward slope in the momentum indicator showing us momentum divergence again, right? So you wouldn't want to necessarily be chasing the market aggressively, seeing these momentum divergences and the market running out of a bit of steam, okay? Now, the VIX did manage to bounce, even though realized vol has remained very low. As I showed you, that kind of range that the S&P has been in is less than 1% over the last week. Realized around 7%, whereas the VIX kind of bounced again from those mid-15 area back up to around 17, right? So, you know, the market perceiving there to be more risk going forward, even though right now we can't seem to be moving, right? And that seems to be a bit of a pattern, like that implied realized spread is staying pretty wide in the current environment, yeah? Now, a trade that I kind of mentioned in my sort of appearance on Real Vision last week was, if you did think a melt-up scenario was still potentially going to happen, even though we're up here, you know, these tech names are showing they're relentless, right? There's enough passive money flows that are buying this market. The discretionary community arguably isn't as long as they could be. They're a bit more cautious. You know, we could have another 5 to 10% upside before this thing ultimately rolls over, right? So how can I get exposure to that without just buying a load of naked calls at the top of the market, basically, right? So the idea there was to look at what the vol surface has done in something like the Qs, right, the NASDAQ. And here you can see that this is for October expiry, right? So we're talking about a 6-week expiry bucket. And you can see what the sort of faded out curve was where it was about a month ago. And the bright green is where it kind of was end of last week, right? So you can see that surface in the upside region, like right now, the Qs are trading around 380. That upside region around 400, 410 has been smashed quite a bit, right? The vol's gone from above around about 16 vol down to more like 12 and a half, which is a decent move down, right, in terms of percentage terms. So what you could do is you could sell the 390 calls, right, in Qs, and you use that premium to buy as many 400 calls as you can for the premium. So you end up having a structure where you don't spend a lot of premium up front. So if the market just sells off directly and that turns out to be a short-term peak in markets, you don't lose anything, right? But if the market does rally, because the distance between those two strikes is only like 2 and a bit percent, you kick in to a load of premium and a load of delta exposure, which is priced on a relatively low vol around 12. And as we rally, you might find that you start to pick up Greeks in a market that's squeezing higher. And certainly if we rally 5%, that would take us to 400. But if we rally 10%, then you get all the way up to 420 and you're looking really good on that trade that cost you no premium, basically, right? So it's a way of getting exposure. It's a bit of a like, you know, nothing comes for free in this world. So know that there are risks associated with that trade. Like if the rally happens too slowly, you are paying time decay, you do have Vega exposure. So there are risks, but the idea is that the surface has moved in a favorable way for that trade. It's a kind of low conviction way of getting some exposure to upside, but it's one of those trades that if the rally doesn't materialize in the next 2 or 3 weeks, let's say into September expiry, then you think about rolling that to November or just taking it off and you won't lose a lot of money. If you let that thing run into the final week or two, that's where you can lose a considerable amount of money, where you could lose up to 10 points. If it goes to 400, that's where is your max loss point, right? I wouldn't recommend running that thing into the death, into the expiry. I'd recommend rolling it if you still think that rally scenario is possible, basically. But I don't think it's a bad trade. And it is one that I did enter late last week. Yeah. Okay. In terms of the sectors, nothing too exciting. You got leadership out of real estate up a few percent, whereas energy, retail, and financials were the laggards, small down, but no dramatic moves. You know, over sort of plus or minus 2-3% really last week. An interesting thing to note is rates vol. So rates volatility has started to come in a bit. We've got the move index here. So it was holding slightly, wasn't really at a super elevated level going into sort of Jackson Hole and certainly not non-farm, but it has started to come off a bit, right? So whereas the VIX has kind of found its floor around that 15-16 area, the move has got room to like come down. It's quite still way off its lows. So we are starting to see the rates vol market suggest that rates volatility is going to come in a bit. Okay. And I think that's because, you know, the taper is kind of priced in. Some kind of soft taper is priced in. So that means a taper tantrum is less likely. So the rates market doesn't need to go crazy on a taper announcement because we're kind of expecting it to some extent. Yeah. Now, what does low rates vol or lower rates vol mean for equities? My sort of theory is that it potentially means less dispersion in equities, right? Which might actually support equity vol rather than equity vol going even lower, right? So we're seeing equity realized super low single digits, implied to holding, right? Interesting. That's interesting enough. But now if we do get a situation where you get less dispersion with sectors, i.e. rates aren't moving wildly, so you don't have to get this big disparity between what rate sensitive sectors are doing versus the other sectors like the cyclicals versus the defensives or whatever it is, the techs versus the energy, those sort of things. They don't need to disperse as much if rates vol isn't that high, right? And the way the equity market kind of prices this dispersion or this correlation is through a metric called implied correlation, right? Which is this. So this is implied, this is the implied correlation for options on January 22, okay? So early next year. So you can see the sort of range that this implied correlation trades in, and it's at the lows of that range. And it's kind of a mean reverting thing, right? It's not really trending, it's kind of mean reverting, yeah? So the fact that we are at lows in implied correlation and now rates vol is starting to come in, if we get a bounce in implied correlation and markets like sectors kind of move more in line with each other rather than in opposite directions, then we may well get a drift higher in implieds, which will support index volatility basically, right? So that's my sort of theory as to why we're starting to see that floor in index vol and where we may actually see index vol pick up as implied correlation starts to pick up and even realized correlation, which is what actually ends up happening basically, yeah? Because ultimately, another reason why we're seeing this kind of these dispersions and divergences is because we've got 5 stocks holding up the market, right? So, you know, how long can these names just hold the market? I mean, breadth in the market we've known has been bad for a while, right? But this shows you, you know, typical what you had the other day, right, where the market was unchanged. Yeah, you had 345 stocks down, 160 up, an unchanged market, and you can see like the stocks that are up are all those big, you know, Facebook, Apple, Amazon, Netflix, Google, Microsoft, Tesla. Those names are what, those big cap tech stocks are what are holding up the market, basically, right? So if the market's going to keep going higher, and again, something I suggested in my interview last week is we need to see them passing the baton over to the cyclicals and a bit more broad-based kind of rallying across sectors, right? And an increase in correlation is what I'm looking for. And we may even see that, and that will be supportive of vol on the upside. Because right now, upside vol is priced pretty cheap. As you've seen on NASDAQ, it's at 12. On the S&P, it's sub 10. So you might get this melt up where sectors start rallying together and actually that upside vol is underpriced, basically, right? So something to keep an eye on there. And then, you know, a reason to believe why we might get some cyclical rallying happening is obviously, as I've been mentioning, Delta variant, right? How is that looking in the US? Well, latest data is showing us a potential sign of peaking, yeah? We've got US daily positive testing results starting to roll over, hospitalizations starting to kind of roll over, not in a dramatic fashion, but you know, it's the start of something, hopefully, right? So the second derivative is turning down, right? So that's a positive. So generally when those things peak, that you often do get a bit of a bounce in the cyclicals, basically, because market prices that in. Now on that front, if you talk about cyclicals, the cyclical index is the Nikkei, right? And the Nikkei has started to exhibit some interesting price behavior, right? So if I bring up the Nikkei chart here, you can see that, well, I've got a couple of charts here, right? So we've got the Nikkei was lagging the S&P quite significantly. And once we broke above that sort of downtrend, we've had a bit of a ratchet higher in the Nikkei, right? So it's done a quick couple of thousand points on the Nikkei, which is pretty decent. And the Nikkei is very much a cyclical based stock market, right? Now, whether or not that turns into something material remains to be seen, but something to add some weight to that argument would be that Japanese equity weightings in the institutional space are actually very, very low. So in general, because Japan's been a bit of a laggard for a long time, they don't feature very heavily in a lot of portfolios. People are generally underweight. And so if that underweight does start to get addressed because we start to see some consistent performance out of Japan, then that adds a lot of fuel to the fire to that Japan trade, basically, right? So, you know, I think the jury's still out. This is just the beginning and a bit of a reflexive kind of bounce from what was a bit oversold and the fact that all risk assets are kind of rallying a bit. You needed Japan to kind of participate at some point. So we've had that initial sort of move. I think, you know, buying into any weakness on a pullback from this initial like knee jerk via call spreads or something in Japan could be a decent trade if you believe in that story that we are going to get a cyclical upturn. Maybe it's a bit early, right? Maybe looking at, you know, what some of the economic data is saying, maybe you don't get that cyclical upturn until early next year. So it might be something to put in, you know, play for early next year. But that is something that's starting to appear on people's radars, like Japan. And Japan does have a habit of when it does suddenly decide to wake up, it can do like 15, 20% in a month quite comfortably and just be completely uncorrelated to everything else, right? Because I mean, it has done that on many occasions in my career. So just something to be aware of, yeah? Okay, so that's kind of the equity roundup. In terms of what to look out for this week, you've obviously got, like I said, a bunch of treasury auctions. You've got a 10-year auction on Wednesday. You've got US 10-year. You've got a 30-year on Thursday. So just kind of keep an eye on those. But I'm not expecting any fireworks, really. Bank of Canada rate announcement on Wednesday. China inflation data on Thursday. ECB meeting on Thursday. you know, trying to get guidance on what they're doing with regards to tapering. People are saying that their tapering is going to be announced in some sort of autopilot fashion. You know, maybe that's supportive to the euro. What's the dollar been doing? Obviously, it's kind of had a bit of a pullback, right? So we back to the bottom of the range. So we had, you know, tests of that top end of the range near 94s, rejected, straight back towards 92, basically, right? Obviously, the first catalyst for that was Jackson Hole coming in dovish, but then the weaker sort of non-farms data, etc., we kind of pushed down to those lows on Friday at around 92. We have bounced off 92, which was kind of predictable given that it's a bit of a level. We could probably bounce as far as this kind of average at around 92.80 before anything has really changed. But, you know, this kind of pullback from the highs in the dollar, you know, suggests that, you know, the risk of a dollar squeeze has kind of abated somewhat, right? Which is probably should be quite good for risk assets in general, right? Risk assets tend to do better when the dollar's not squeezing aggressively. And that did prove to be a pretty strong resistance level around 94. So for now, that's probably positive risk, right? In terms of the other currencies, euros at an interesting level, obviously 119 kind of equated to that 92 level in DXY. Like I said, maybe ECB meeting provides some fuel to break that level. If that level is broken, then, you know, you've got a couple of levels. You've got 120 and maybe then 122 to look out for. So, you know, euro could, if it can manage to break this range, you know, euro could have some legs. But I think we need to see something significant out of the ECB on that front to really catalyze that, right? If you're a bull on euro, I'm pretty sure call options on euro are not expensive. FX vol's generally pretty cheap. So 120 calls or something like that with a couple of months to go on them. You kind of need to pick options that are a little bit longer dated expiry in FX because otherwise they very rarely tend to work. You kind of need to give them more time for the trend that you believe is going to happen to actually manifest, because it can happen like 20 bips a day at a time, right? Slowly, but just going in one direction. So you need to go probably at least 2 months out. But I suspect the 120 calls aren't overly expensive. Yeah. Okay, that's where we are in FX. Other than that, nothing overly interesting from my perspective in FX land. In terms of commodities, what's been going on? Oil, a bit boring, really. OPEC kind of did what they were expected to do, and oil's just kind of paused. It did push above 70. It's having a nice little correction retracement, but, you know, no reason to think that oil doesn't continue to kind of go higher over time. But, you know, it's a bit choppy. Yeah. But overall, fairly boring oil. I obviously have been long, bought some at 67.5, bought some more at 63, flipped out of the clip that I bought at 63 to give myself bullets to re-engage and add longs if we do come off again. But I'm not holding my breath on that pullback necessarily, but I am maintaining some long exposure. Yeah. In terms of gold, you know, showed some signs of life on that payrolls print. You know, why did precious metals like that payrolls print? Well, we had weaker economic data in terms of number of payrolls, but we had average hourly earnings ticking higher, which basically suggests a more stagflationary outlook potentially. That's what is kind of tends to be the dream for precious metals. So that's why you had the uptick, but, you know, pretty strong rejection again of this key resistance that we keep coming across of 1835, right? So gold just cannot break the 1835 level. Silver, as I sort of flagged, silver, you know, was the better value proposition within precious metals, given where it was relative to gold and kind of its chart. And it had a nice pop of around 3%. But as gold has stalled, it's done the same, right? So I had picked up some silver in that correction down to 23. I flipped out of half my position on that pop. And I'm running a trailing stop on my balance at around 23.70, which kind of these recent kind of lows. So if that support there breaks, then I'm out of my silver for now, right? But I do think the silver is a better way to kind of play a slightly bullish view on precious right now. because it's got some of that industrial metal sort of element to it as well. Yeah. And it does look relatively cheap as well if you look at the gold silver ratio. Yeah. What else has been happening in commodities? So gas prices absolutely going berserk, right? So I don't look at gas very much, but I mean, it's gone parabolic, right? And you know, you've got natural gas, you've got specific kind of grades of gas like in Europe and stuff that are going absolutely crazy. And that is threatening to potentially, you know, derail some of the economic recovery in Europe, which could be a problem, certainly heading into winter, right? So something to be aware of, gas prices are a problem, right? And we're seeing, you know, coal, because of that, we're seeing coal, power, emissions prices, everything going up quite exponentially, yeah? And it's also dragging up uranium, right? So you had a bit of an explosion in uranium last week, or over the last couple of weeks, right? So you look at URA, which is the uranium, this is the uranium underlying. So literally from 17 to 24, I mean, that's a huge rally in a matter of 2 weeks, right? So what is that on the back of? Partly on the back of the fact that there's this squeeze going on in energy, in gas, etc. So, you know, there's a focus on the need for more forms of clean energy, and, you know, nuclear is being touted as potentially, you know, going to be very necessary for that clean energy agenda. And, you know, Europe is considering it, let's say, more clean than it has done previously. You also had the Sprott physical uranium ETF that's been launched recently, and that's got a bunch of inflows coming to it. So you've got people basically allocating into that space, and that's been a bit of a driver for that move higher. So you had the uranium stocks were outperforming the uranium underlying, and they were starting to look a bit overvalued potentially. But now this sort of ratchet higher in spot has maybe, you know, put the spotlight on that space again and made people excited about that space. I've been allocating to uranium for the last sort of 6 months. So I'm happy to see that move. For me, it's a long-term allocation, right? It's part of my general commodities theme, looking for commodity exposures that I think are going to do well over the longer term, whether it's copper, whether it's uranium, whether it's carbon emissions. You know, there's plenty of places where you can park a little bit of capital to have diversified exposure to commodities that are fairly scarce, that you know there's going to be an underlying demand for, given where we're heading, basically, and the signs that we're getting from policy and climate agendas, et cetera, yeah. And if you zoom out of the this chart on uranium to say the monthly, well, it's quite a different picture, right? You can see that, you know, since 2011, uranium's just fallen off a cliff, and it's, you know, it went through this long bottoming process between 2016 and 2020. And now we're starting to see signs of life, right? So even though it looks like we've gone up a lot recently, I mean, longer term, if this is a longer term play, you've got ridiculous upside potential there. If what people in the space think is likely to happen, there's a massive supply deficit. The projected demand for cleaner energy is going through the roof. You know, it's not a bad place to be. Yeah, in my opinion, in my humble opinion. And then lastly, you've got the general commodity rally seems to have slowed a bit, obviously on the back of concerns about global demand, global growth, the Chinese credit impulse, things like that. So even though commodities have somewhat paused, you could argue, see here, you've got all the commodities on there, right? Showing you the performance, obviously, year-on-year changes in 12 months. And obviously, so the whole commodity complex has done pretty well, apart from precious that's been rolling over a little bit. But the rest of the commodity complex, whether it's agriculture, energy, industrial, has done pretty well, right? No surprise there. But look at what the 1 year roll curve looks like, right? So this basically takes the average of what the futures roll is on all these commodities, right? And the futures roll is just telling you, giving you a sign of the tightness in the market. So when the short dated futures trade much above the longer dated, it's saying it's a tight commodity market, basically, right? There's supply constraints there, basically. So you can see that that's still well, even though it's come off the highs, it was up, the average was at about 5%, but it's still clearly positive, right? Which is generally a supportive environment for commodity prices when you've got that positive sort of roll in terms of for holding longs, basically. As you roll to longer dated contracts, you get paid for it, basically, right? So that's usually quite a good environment for commodities, which, I'm just a buyer of commodities. So I think they're a good diversifier. I think a lot of these supply constraint and these supply bottlenecks are just going to take a lot longer to dissipate than people think. And so buying dips in commodities that you like, I think, is just a strategy that you need to continue to do, basically. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.